This podcast is sponsored by Milliman. As one of the world's largest actuarial and consulting firms, Milliman's work is vital to solving the challenges faced by our clients, society, and the world. Through actuarial, risk management, and related technology and data solutions, we help companies navigate the complex health, finance, and insurance landscape. Because the future demands a different kind of thinking from a different kind of company. To learn more, visit milliman.com.
Hello and welcome to the second podcast from the Actuary, produced on behalf of the Institute and Faculty of Actuaries, the IFOA. I'm Jon Watkins, a financial journalist and your podcast host. For the next half hour or so, I'll be talking to three actuaries, all doing very different things and reflecting the diverse scope of the profession. I'll be speaking to an actuary in the House of Lords, someone who spoke at the IFOA's Life Conference this autumn, and a member who is based in New Delhi, India. So let's meet our first guest, Lord Davies, a pension specialist and Labour peer. He was recently interviewed in the Actuary's November-December issue. So Lord Davies, Bryn, you are the only actuary ever to have spoken in the House of Lords and a Labour peer who has mixed with plenty of government greats and professional giants across a career, combining politics and pensions in equal measure. And I'm delighted that you've given up some of your time to join us today and chat about your career and some of your views on the actuarial profession. Thanks for joining us.
Thanks for the opportunity.
It's good to have you here. That's for sure. So I mentioned in the intro there that you're a qualified actuary and a Lord in the House of Lords. There can't be too many of those. Pretty unique, isn't it?
Well, as far as we know, there's only been one previously, Lord May of Weybridge in the 1930s and 40s. Interestingly, he never actually spoke, as far as we can tell. There's no record of him speaking in Hansard. So I can claim to be the only actuary who's ever spoken in the House of Lords. And of course, there have never been any actuaries in the House of Commons. So I'm the actuarial voice in Parliament.
You've been a peer for 4 years. Can you give us a flavour of what it's like day to day? What generally does it involve on a daily basis, being a peer?
It's very much, you're left very much to your own to decide what to do. I take the Labour whip and I get instructions from our whip. But when I turn up and when I speak, it's very much down to me. I promise to be a full-time working peer. The House meets 4 or 5 days a week, and 3 of those days we work on into the evening. So it's quite a commitment. I didn't really do my due diligence sufficiently. I had to be honest, I didn't quite realise how much late night work was involved. When we're in session, I go in every day, speak on issues of interest, speak on issues when the whips encourage me to. That's quite a thing. And just try and put over issues that fundamentally I'm interested in. You have to specialise. One thing I've learned is there's so much interesting that's going on that you have to focus on issues where you've got something extra to contribute. Obviously pensions, I say a lot on pensions. Also mental health has always been a big topic for me. London as well is a big issue.
Yeah, and you touched on there the sort of, speaking on the things that I guess you feel you have the right to speak on or the knowledge to speak on. How do your actuarial skills inform your role in the House of Lords?
Well, it's rarely a direct actuarial input. The main advantage, it does give you a certain status. People do respect the qualification, and I gain some kudos for that. But you also have to deliver. You have to say things which are intelligent based on that. The people in the Lords, there's some really fantastic people there.
Yeah, that makes a lot of sense. I wanted to turn somewhat to the profession now, if that's all right. What, in your view, is the big issues today for pensions actuaries in their work?
Well, of course, there's the big shift, the short-term issues, what's going to be in the budget at the time of recording. That's a big issue. But also the government have got these twin-track pension reviews going on, and so I try and have an input to that. Clearly, there is a role for pension funds in building growth in our economy. But that has to be to the benefit of the members. The money isn't there as a free lunch for the government to do with whatever it likes. The object of the money is to provide people with pensions, and that should always be borne in mind. And then in the longer term review, the government say they're going to look at wider issues, including the key issue for me, which is adequacy. There's this tendency to always talk about saving, but my major point that I always make when given the opportunity, such as now, is the state pension has to be part of the mix. You can't decide what private pensions are going to do. You can't decide what's an adequate private pension unless you've got a clear idea of what the state is going to provide. My position for a long time has been it's not good enough. I was a great fan of the state earnings-related pension scheme, SERPs, when it was introduced. I think it's a tragedy that it's been progressively cut back and then abolished over the years, leaving a massive gap which really hasn't been replaced by automatic enrolment. Other changes to automatic enrolment need to be made. That's a big issue. And also, what's the scope for improving the state pension? It's worth saying that the triple lock is very controversial, but it's really acknowledgement by the major parties that the state pension isn't good enough. The reason why we want the ratchet effect, which the triple lock inevitably produces, is that the current levels aren't good enough. And we need to keep the triple lock until the pension, the basic part of the pension is sufficient. And then the question is what else is provided on top of that.
And with the Labour government now again in power in the UK, what is your main hope for pensions policy and reform beyond that? I mean, you've talked a lot there about, the state pension, and how else might a change of government impact our profession, in your view?
Well, on the first one, I've sort of nailed my flag to the mast in what I just said about the need for improvements in pensions. It's all up for grabs at the moment, and there's a steep learning curve for government ministers. They've got a lot on their plate. We've got the appalling fiscal inheritance, which action is going to have to be taken in the budget. Adequacy of pensions isn't going to be their top priority in the next year or two, but my objective is to make sure it's on the agenda and people are thinking about it in a coherent way. And the second part of your question, implications for the actuarial profession, we don't yet know really, because it all depends which way the pensions debate goes. I noticed on the Institute discussion group on pensions this morning that there was a whole discussion about are pensions actuaries going to become life actuaries. I think that's sort of assuming the outcome of current considerations when it's still very much up for debate. I don't think all pensions are going to go to life companies. There's going to be other forms of structure providing pensions, most obviously CDC, but also many more schemes now thinking about the run-on and not switching straight to life companies. So there's a big debate and a lack of clarity about how that change is going to pan out.
As you say, it's a lot up in the air and a lot on the table. Talk a little bit about your career, if that's all right. You spent a lot of time in the public sector. Has that been rewarding for you?
Oh yes, it's really what I've wanted to do, and I've been very lucky. The opportunities to serve in different ways has come along. I was a local authority councillor. I worked for the TUC, which is a form of public service, supporting trade unions, negotiating with their employers, looking for improvements in pensions. We saw big changes over the period when I was doing that, not always to the good. But I'd encourage all actuaries to think about this as part of a career. It doesn't have to be the entire career.
You mentioned the TUC, and you spent a big part of your career advising unions and on pensions. How have things changed in that area over the years? What have been the biggest shifts that you've seen, and the most sort of, seismic shifts?
Well, the seismic shift, of course, has been the switch from DB to DC. When I started work, we had the introduction of contracting out, when there was a massive improvement in the number and the quality of occupational pension schemes. Even at their best, they only covered about half the working population, but they were good schemes, and the rest of the population, of course, were accruing benefits. Then slowly and then suddenly, like Hemingway said about bankruptcy, we saw the shift from DB schemes, these good DB schemes, shifting. Employers closed them to new entrants, they closed them to further accrual, and people got DC schemes. Where the trade unions were strong, they were able to negotiate decent DC schemes. I'm not against DC schemes in principle, as long as they're good enough. The problem is that so many of them, particularly where unions weren't looking after their members, the DC schemes were woefully inadequate. And everyone, I think, there's general agreement that the minimum contributions, less than 8% of pay, because it's only band earnings, that's not enough. As I say, it also depends what you get from the state. A better state pension, the 8% might be enough, but that's a debate that needs to take place that just isn't taking place. I very much hope that the second part of the pensions review will tackle that. We saw the work of the Pensions Commission 20 years ago now, and they set what I think were good standards of adequacy. If you read through the report, it wasn't part of their final recommendations, but they actually set figures for what people's pension should receive based on their pre-retirement earnings. We're well short of that at the moment. So the question is, do those standards still apply? Maybe they ought to be better. And if they fall short of that, how can we improve them? Both through improving automatic enrolment, but also, in my view, improving the state scheme.
Brilliant, fantastic, brilliant. Thank you so much for those insights. Finally, I guess I have to ask you, politics or maths?
When the question was floated, I don't think of myself as a mathematician. Right. I love numbers, but that's not quite saying oddly, first time I took maths A level, I failed. Get a decent grade in a reset, but my life has been driven by politics. Yeah. Everything I've done has had that in mind. I would describe myself as being numerate rather than a mathematician, and that's been an absolute godsend throughout my entire career. Being able to understand numbers and see the risks and the advantages of different courses of action when they're assessed in numerical terms.
Well, Lord Bryn Davies, thank you for sharing lots of insights from that career and your views more generally on the profession and the wider issues that are really pressing today. And thanks so much for joining us.
Thank you.
If you haven't already, do read the interview with Bryn in the November-December issue or online at theactuary.com. Now we're meeting Sarah O'Sullivan, Head of Strategy and Regulatory Change at Phoenix Group, who dialed in for us from the IFOA's Life Conference this autumn. There, she spoke on the subject of Solvency UK and matching adjustment. Sarah, it's great to see you. Thank you so much for joining us and indeed for joining us live from the IFOA's Life Conference in Manchester. Good to see you.
Yeah, thanks very much for having me, John.
So we're going to run through a few questions about this issue and indeed your session there. But first of all, how are you finding the Life Conference generally? Are you enjoying connecting with so many members who work in the same practice area of you? And what's the general vibe there?
Yeah, it's been really great. So the conference has been just so vibrant. There's so many people here, lots of like old colleagues that I get to reconnect with, as well as like meeting new colleagues in really different areas. So getting to see people doing different talks and then like connecting with them immediately afterwards. It's just such a great vibe.
Fantastic. Now, look, in June this year, the new UK solvency matching adjustment regulations around eligibility took effect, with more to follow in December. It's a very technical area, but broadly speaking, is seen by some as a way of increasing insurance investment in big infrastructure projects. This was a big focus of your session at the conference. So can you tell us a bit more about that and the key messages of your session?
Yeah, absolutely. So yeah, we've been working on reforming the solvency regime for probably about 5 years. The rules that came into effect in June involved really a lot of work across the whole industry, and including the regulator and the government as well. So it's really, really exciting to see those kind of come into effect now. I think while the ambition of the reforms was really great, and we were very, very supportive of this idea of helping the insurance sector to boost and support the economy, I think our view was certainly that while it was a step in the right direction, we should really maintain that momentum and continue to evolve the regime. And so my session was around the idea of introducing a matching adjustment sandbox, which would allow firms and the regulator to really safely test further expansion of the existing rules to allow us to invest in a broader range of assets that would, support the economy, and also help to transition the economy to net zero. So really that was the focus of the talk, was around, what are the pros and cons of different design ideas around the sandbox.
And we mentioned there that the regulations only came into effect in June. Have you seen any big shifts already in the life sector, or will it be more of a sort of slowly evolving change? And regardless, how do you see it evolving into the future?
Yeah, so I think although the rules will have just come in June, they were put together very, very quickly. So the regulator and the government worked very, very hard to bring them in at absolutely rapid pace. So there'll be quite a lot of work involved in getting firms to a position where they're ready to apply to get approval for those new assets. So although the rules have changed, we still need to go through the process of having the regulator check and approve everything before anyone invests. So I think it really will be a bit more of a slow burn, and it will take some time for that to kind of work its way through the system before we'll be able to see what the actual tangible outcomes of those reforms around eligibility are. But going forward, what we should start seeing is a bit more streamlining of the process, assets going through a little bit more quickly. And hopefully if the sandbox proposal is taken up by the PRA, then we'll hopefully see continued expansion of the types of assets that we can invest in, which should just build up on that existing momentum to allow us to contribute more and more to society through the investments that we make.
Yeah, the Prudential Regulation Authority, or PRA, has regulatory oversight of the solvency regime. And within that, it has two main objectives, which are around financial stability and growth. Do you think there is an appropriate balance between those two objectives? And if so, how do we maintain that balance going forward?
So yeah, the PRA's two objectives, they are tiered to each other. So they have a primary objective around policyholder protection, and they've now got a new secondary objective around economic growth and the international competitiveness of the UK economy. So while that objective is new and it needs to kind of bed down within the regulator, so I think again it's going to be a bit of a slow burn in terms of how that actually plays through the regulations. It's going to take some time before we start really seeing the effects of that new kind of like shift in mindset for the regulator. I think what all we've seen so far is different speeches from the regulator where they're trying to explain how they think they're going to start incorporating that new secondary objective into the regime and into their internal processes. And so far, I think the focus on those speeches has very much been around risk management. So this idea that in order for us to compete internationally and for the UK to have sustainable economic growth, it's very, very important for the financial sector and the insurance sector to be really robust and to give investors especially that confidence in the sector and in the economy. I think really it remains to be seen how the PRA does balance that with ideas around kind of, innovation in the sector. So yeah, again, I think it's just going to have to be a little bit of a wait and see. But the government has been very clear that it wants to enhance the transparency and the accountability around the regulators. Now, again, we've yet to see how the government is going to really actually implement that. But as we start understanding how the PRA is going to be measured against its objectives, it might start to become clearer the type of activity that we might start seeing around kind of growth and innovation in our sector. But again, we're just going to have to wait.
Right, I see. And just thinking of life from the consumer side, do you think the regime could be seen as too prudent and that there's a risk that it's excluding policyholders from accessing the right protection?
Yeah, it's a really interesting question, John. And it's also a really important question. I think, in the consumer research that we do at Phoenix Group, we certainly see that our customers do grapple with, the cost of living. We know that pensioners are not saving enough for retirement. So when we look at things like the cost of annuities under the current regime, certainly a lot of customers think that the cost of annuities is too high. And that does beg the question of, are policyholders getting access to the right types of protection that they need in their retirement? So whether the right balance is being struck really, I think, is, a matter of judgment and opinion. And I think different members of the profession and different, colleagues in the industry will have a variety of views on it. And yeah, I think it's a really important question that I think the profession really should look at. And both, us as a profession, as individuals, where we're also worried about kind of our own pensions and the products that we can access. It's really, really interesting, but I'm not sure that there's one correct right answer to that question.
Yeah, fantastic. And Sarah, thanks so much for that analysis of what is a complex but really interesting issue. We mentioned that you are there at the conference right now. Is there something that you've particularly enjoyed in your time so far at the conference, or indeed something you're particularly looking forward to?
Probably the highlight of the conference so far for me was yesterday's proxy modelling talk. I just thought it was just academically excellent, really, really technical. It's going to be some great CPD for me. It was just really well delivered and just so thought-provoking. And it's an example of, the type of, it's really deep thinking, but really innovative and smart. And it's the type of thing that really made me want to be an actuary in the first place. So it felt like quite rejuvenating and refreshing, that talk. But as well, like, as I mentioned, like, the networking has been exceptional, and it's just been so great to bump into so many friendly and familiar faces. And yeah, it's been just wonderful hanging out with everyone and meeting, new and old friends.
Yeah, what a great positive message to end on. Sarah, thanks so much for joining us and enjoy the rest of your time there.
Thanks very much, John.
Switching studio now and moving on to our third and final guest, Akshay Dhand. Akshay is an actuary based out in New Delhi in India. Welcome, Akshay, and thanks for joining us. You're going to talk to us a little bit about your role and also the new Chartered Actuary designation and what that means to you. But before we get going on that area, tell us a little bit about yourself and what actuarial role you're in.
So I am currently the appointed actuary for Canara HSBC Life Insurance. I originally come from a small town in the Punjab region of India called Jalandhar, and I did my graduation in mathematics from University of Delhi. And during that time, I came across the subject of actuarial science. And given that I was very keen to use mathematical skills, which I had learned during my graduation in my career, so the actuarial science as a career seemed to be a very interesting option for me. However, at that point in time, the insurance sector in India had just been denationalized, and hence the demand and scope for actuaries in India was quite limited. Then I'm talking about year 2002. So as such, I decided to move to the UK to pursue my master's in actuarial science from City University of London, post which I started working in the UK itself in HSBC Life in Southampton. I worked there for a period of 4 years from 2003 to 2007, during which time I had qualified in 2006. And then in 2007, I moved back to London and joined Deloitte's actuarial practice in London. And then in about 2009, I received an email from one of my previous CEOs from HSBC Life, who had been sent to India around the same time that I had moved to Deloitte to set up a life insurance joint venture in the country. And he asked me that if I wanted to join him in India, because he said that they needed actuaries in India. The number of actuaries were very limited. And he said, because I know you are originally from India, would you like to join us back? So while as such, I had no intentions, but because it seemed like a good opportunity, I moved back to India in April 2010 and joined Canara HSBC Life Insurance as the joint venture is called. And while I did not plan to stay in India for that long, but fortunately for me, I kept on getting growth opportunities within the company itself. And now actually I've been in the company for 14 years now. So that's a bit about myself.
That's an interesting journey. Very interesting. What are the top two sort of trends in the life insurance space in India right now?
So India is a very competitive market. It's a new market. It's only about 25 years old. And like for most things in India, it's very chaotic. There's a lot of focus on new business growth, but there's a lot of competition. There's a lot of chaos. So there's never a dull moment while we work in India. It's also a very heavily regulated market, which means that the regulator impacts all aspects of an insurance company's operation in India. And things change on a regular basis all the time in India. Multiple stakeholders are involved. Things change very rapidly. One has to constantly change their plans and their strategies to align with the changes in the industry and the environment. So what's happened recently, in fact, is that the IRDAI, which is the insurance regulator in India, has taken a mission of insurance for all by the year 2047. 2047 being the year in which India completes 100 years of independence. So currently the rate of penetration in the country for insurance is quite low. It's just about 3%. And as part of this mission, IRDA wants to really increase the penetration of insurance across the country. And just over the last few months, they've brought about a slew of regulations which are impacting various areas of the insurance industry. So these include regulations affecting insurance products. They include regulations affecting protection of policyholder interests, and so on and so forth. So what the companies across the industry are doing right now, that aligning their products, their plans, their processes to meet the requirements of the new regulations. In addition, what has recently also happened is that while India has been wanting to implement IFRS 17 as well as risk-based capital for a while now, they have not been able to do so. And very recently, they've just announced firm timelines for the implementation of these two regimes. So again, companies will be starting to, look at how to implement these regulations within the timelines. So these are the few trends which are affecting the Indian insurance space at the moment.
Yeah, it's clearly an interesting time and an exciting time as well, I guess, with modernisation and progress. The IFOA has recently launched the Chartered Actuary designation. You've decided to adopt it. Tell us a little bit about why and what that means to you.
So for me, I decided to add the word Chartered Actuary to my designation because I thought it would improve my credibility as a professional. Because in my part of the world, chartered accountant is considered to be a very hugely respected and a desirable profession. So while I think an actuarial profession is at par or even better in various aspects as compared to, say, a CA, it still doesn't really attract the kind of credibility and respect which it truly deserves, given the kind of crucial work which we do in the insurance sector as well as the pension sector, as well as the new sectors of investments or risk management for that matter. So I feel adding the word chartered would add a bit of more appeal to the profession, and it would increase its credibility, which is why I decided it was a good time to adopt the new chartered status.
Yeah, that makes sense. And that's a little bit about what it'll mean for you on a personal level. What do you think chartered status will bring to the profession more widely as a whole?
If you add the word chartered as a chartered status, I think it makes people sit up and take notice about the profession because, in most parts of the world and more so in India, the profession is quite relatively unknown. So that would help increase the appeal of the profession among the people. Secondly, it will also help, I feel, actual professionals will get more credibility, especially in the new areas. So in the areas of insurance and pensions, you can't do without actuaries. But in some of the newer areas, such as, investments, such as banking, sustainability, etc., in these areas, when you hear the word chartered actuary as opposed to hearing the word actuary, it probably will add credibility and historically, where other professions have been the preferred choice for employers, the employer will sit up and take notice about actuaries as well. And finally, even from a student community who wants to, perhaps pursue actuaries as an actuarial profession as a career, and they are still deciding their career choices, when you hear the word chartered actuary as a profession as opposed to just an actuary as a profession, I think it increases the appeal for the students as well. And I think that will help more students, trying to find out about the profession and hopefully increase the membership of the profession.
Yeah, all positive steps. In the summer, you were voted onto the IFOA Council. I think you flew across to London for your first meeting recently. How was that? How are you finding it? How are you enjoying that?
So while I've lived in the UK for studies and work for about 8 years, and I actually visited the country every year, but the trip to London in September this year was really special. Like I said, like you said, for a start, it was my first council meeting, and also my chance to go back to Staple Inn, which is the place where I graduated as an actuary way back in 2006. So it was a nice moment from that perspective. Plus, meeting some of the other council members was truly amazing. I mean, the kind of work these guys are doing is quite incredible, and also their dedication to the profession over and above what their regular work is truly commendable, because there's a lot to do when you're an actuary working. Plus, on top of that, to give time to become a council member and work for the profession is truly, truly amazing. And then we also got to visit the IFOA library, and we ended up seeing rare documents like the Royal Charter, which was there from 1884. That was also kind of amazing. I've now, in fact, attended 2 council meetings now. I've recently attended the one in November, and I've also started contributing to some of the working groups, which the council has, and I look forward to getting involved in more areas. So overall, I'm really enjoying the new role, and I hope to make a difference to the profession.
Yeah, absolutely. Akshay, that's fantastic. Something we like to ask lots of our guests is what you feel is the best thing about being an actuary. Can you share that with us?
Sure. So I think for me, the best thing about being an actuary is the ability to enable insurance companies to design and manage the provision of life insurance services to the general public. So I find this is a very noble and a rewarding feeling, because you're providing financial support to families, when they're going through a bereavement. So whenever an unfortunate incident like death happens in a family, there's a lot of grief and sadness, and the last thing one would want to worry about is at that point in time is financial insecurities. And life insurance, in fact, is the only tool available to people to deal with this issue. And I feel extremely satisfied that as an actuary, I'm a huge part of the life insurance solution. So that's for me the best bit about being an actuary. In addition, I've always been good at mathematics, and the fact that my career revolves around numbers is something I'm very happy about. And finally, the credibility and the respect that a profession enjoys is an added advantage. So I really truly feel I'm blessed to have chosen this career, and I've never regretted this decision.
That's absolutely fantastic, and thanks very much for sharing all of those thoughts. Thanks very much, Akshay, and thank you to all of our guests in this episode. We hope you've enjoyed listening. Do join us again for our next podcast episode coming up after the January-February issue of the magazine is released. We look forward to seeing you then.
This podcast is sponsored by Milliman. As one of the world's largest actuarial and consulting firms, Milliman's work is vital to solving the challenges faced by our clients, society, and the world. Through actuarial, risk management, and related technology and data solutions, we help companies navigate the complex health, finance, and insurance landscape. Because the future demands a different kind of thinking from a different kind of company. To learn more, visit milliman.com